While the world was distracted by the stock price, Tesla just quietly moved $44 billion into cash and burned the bridge to the old auto industry. Are we looking at a tech giant in hibernation or a falling knife? Hello, welcome to the Capital War podcast. Today, we are not looking at a car company. We are looking at an AI sovereign state disguised as an automaker. If you thought the last few years were volatile, the 10K report released for fiscal year 2025 shows a company undergoing a complete genetic modification. We are seeing a massive pivot from selling hardware to selling autonomy, and the financial statements are screaming that the transition is messy, expensive, and absolutely critical. Let's start with the headline number that scares the casual observer. Net income has collapsed. We are talking about a 47% drop year over year. In 2024, Tesla brought in over $7 billion in profit. In 2025, that number shrank to under $4 billion. If you're a traditional value investor looking at price-to-earnings ratios, this looks like a disaster. The profitability compression is severe. It's like a high-performance athlete suddenly gaining weight before a big fight. You have to ask, is this muscle or is this flab? But here's where the story gets interesting. Revenue is down 3%, sitting at just under $95 billion. For the first time, we are seeing a contraction in the top line. The days of 50% annual growth are gone, replaced by a brutal reality check. The auto margins, once the envy of the industry, have compressed to 17.8%. Why? Because the world changed. The One Big Beautiful Bill Act passed in July 2025 effectively killed the EV tax credit for many consumers. That is a regulatory asteroid impact. It raised the effective tax rate for Tesla to 27% and stripped away the demand lever that Elon Musk had been pulling for years. So, why is the balance sheet bigger than ever? Tesla is sitting on $44 billion in cash and investments. That's up $7.5 billion from the prior year. Think of this cash pile as a war chest. While profits are down, liquidity is up. This is the classic fortress balance sheet strategy. When the macroeconomic weather gets stormy, you build a bigger roof. They're preparing for something massive, and the clues are buried in the capital expenditure forecast. They are projecting to spend over $20 billion in 2026. That's not for building more car factories to stamp out metal shells. That money is going into compute infrastructure. They are buying the most expensive shovel in the gold rush, AI training capacity. The Cortex training cluster at Gigafactory, Texas, and the new supercomputer assets are eating cash like a furnace. This is a bet on the Robotaxi service, launched in June 2025. They are pivoting from a hardware sales model, where you sell a car once, to a service model, where that car generates revenue every single day. This is the service-driven pivot. It's the difference between selling a DVD player and owning Netflix. Hardware is a commodity. The service is the recurring revenue engine. The 10K explicitly states that the future depends on this. They are burning the boats. There is no going back to just being a car manufacturer. If the autonomous ride-hailing platform works, that 17% margin could explode upwards because software margins are typically 80% or higher. But if it fails, that $20 billion spend is just a very expensive bonfire. Let's look at the bear case, because we have to be intellectually honest. The biggest risk right now is what I call the Musk Misalignment. The report warns that the product goals, specifically the Robotaxi and the Optimus robot, might be misaligned with consumer demand. Imagine spending billions to build a perfect robot butler when the market just wants a cheaper hatchback. That is the nightmare scenario. If the technology does not meet the hype, or if regulations strangle the rollout, Tesla is left with massive depreciation on assets that generate zero cash flow. We also have to talk about the OBBBA shock. The repeal of tax credits has fundamentally altered the unit economics. Tesla can no longer rely on government subsidies to pad the bottom line. They have to win on pure cost efficiency. That's why we're seeing such aggressive cost-cutting measures, including the convergence of AI chip design efforts. They are trimming the fat to feed the AI beast. However, the energy sector is the sleeper hit here. Energy generation and storage revenue is up 27%. The margins in this segment jumped to nearly 30%. While everyone watches the cars, the battery business is quietly becoming a profit engine. It's like finding out your boring utility stock is actually a high-growth tech play. As AI data centers demand more power, Tesla's megapacks are becoming the grid's best friend. This diversification provides a safety net while the auto business goes through its painful metamorphosis.
From a valuation perspective, you cannot look at the 2025 earnings and make a linear projection. You have to look at the scenario analysis. Scenario A is that the $20 billion spend pays off, Robotaxi scales, and Tesla becomes the dominant transport utility of the 21st century. In that world, the current compression is just a blip. Scenario B is that the tech hits a wall, the regulatory environment tightens further, and they are stuck with high fixed costs and shrinking demand. That is the binary bet you are making right now. The free cash flow is still positive at over $6 billion, despite the heavy spending. That is the lifeline. They are self-funding this massive gamble. They are not diluting shareholders to keep the lights on. That is a sign of financial maturity, even in the face of declining profits. It is a high-wire act, but they have a very strong safety net underneath them. So where does that leave us? Standing on the edge of a cliff or a launch pad? To answer that, you have to look at what they are actually building in the dark. The 10K confirms that the Robotaxi service is currently running on the Model Y platform, but the real endgame is the Cybercab. This is their purpose-built autonomous vehicle. They are betting the farm that they can mass-produce a car with no steering wheel cheaper than anyone else can build a traditional sedan. This is where the $20 billion capital expenditure number for 2026 becomes the most important figure in the entire report. They aren't just buying servers, they are building a digital fortress. By expanding the Cortex training cluster at Gigafactory, Texas, and partnering with Samsung for custom AI semiconductors, Tesla is trying to create a computing monopoly. Think of it like building the railroads before you even try to sell a train ticket. If they own the most powerful AI training infrastructure in the world, catching up to their self-driving data becomes mathematically impossible for a legacy automaker. But here's the catch, and it's a massive one. They are doing this while their core business is shrinking. Revenue from selling cars dropped by over $6 billion in 2025. The growth story of selling more EVs every year has stalled. They produced 1.7 million vehicles and delivered slightly less. That is flat. The exponential curve has flattened out. If you are valuing Tesla as a car company, a price-to-earnings ratio of roughly 40 looks insane when earnings are falling by half. However, the sum of the parts valuation is screaming a different story. Look at the energy business again. Deployments hit 46.7 gigawatt-hours in 2025. Revenue in that segment is up 27% to nearly $13 billion. And remember those gross margins? Nearly 30%. That is software-level profitability in a hardware business. They are effectively running a profitable, high-growth utility company inside a struggling car manufacturer. This segment alone provides a floor to the stock price that didn't exist 2 years ago. The One Big Beautiful Bill Act, the OBBBA, is the wild card. By repealing the tax credits, the government has forced Tesla to compete on raw price. This hurts margins now, as we saw with the drop to 17.8%, but it also kills off weaker competitors who needed those subsidies to survive. Tesla has the cash, $44 billion of it, to survive a price war. Their competitors do not. This regulation might actually be a moat in disguise, creating a survival of the fittest scenario where Tesla is the last man standing.
So, is this a value trap? A value trap is a cheap stock that stays cheap because the business is dying. Tesla is not dying, it is molting. It is shedding its old skin as a car manufacturer to become an AI robotics firm. The risk is execution. If the cybercab is delayed, or if regulators block the full rollout of the Robotaxi network, that $20 billion spend becomes a heavy anchor. But if they pull it off, if they successfully transition to a service-driven model where a fleet of millions of cars generates passive income, the current valuation will look like a rounding error. You are not buying a car company today. You are buying a call option on the future of labor and transport, with a profitable battery business covering the premium. The verdict for 2026 is show me. The financials are ugly right now because they are meant to be. They are sacrificing short-term profits for long-term dominance. If you have a 5-year horizon, this is the time to watch the execution of the cybercab ramp and the energy margins. If you are a trader looking for a quick bounce, the volatility might eat you alive. This is the AI realism reset. The hype is gone, the hard work has started, and for the first time in a long time, the price of the stock might actually reflect the difficulty of the mission.